Welcome to the SDA Housing Podcast, brought to you by NDIS Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hello everyone, my name is Minh and I'm your co-host with Jessica from our office, and you listen to the SDA Housing Podcast, a show that explains, highlights, guides and brings awareness about all things SDA in this ever-changing and diverse world. Jessica, hello.
Hi, Minh.
Today's topic is GST and input tax credits and all the other stuff that comes along with the ATO and SDA, I think. Jess, would you agree that this is the topic today?
Yeah, definitely trying to figure out the muddy waters of GST and tax treatment of your costs in owning an SDA property.
Now, we're covering this topic because on July 1, the SDA calculator and the new price review for SDA came out with a lot of topics on GST, input tax credits and all that kind of stuff. So I thought it might be great for us just to talk about all the relevant GST and input tax credits that could be going through people's mind, as in, why are we even talking about this review? How is it relevant to us as an investor, I guess? So, Jess, where do you want to start with this topic here?
Well, I guess we'll start from the perspective of there's two areas where you would be concerned with whether or not you can claim GST. That's either in building your property or in the ongoing costs of renting out your property. And we're basically trying to get to a position of, okay, in order to make sure you could maximize your ability to claim for GST on the build costs of the property and potentially then on the ongoing rental expenses, what's been said by the ATO, what's been said by the NDIA, and how does that all apply, I guess, to a generic investor?
Okay. So, Jess, up until now, we people who are investors, and I'll talk on behalf of the investors here, we always knew that there was possibly some GST rebate refund if you probably bought your SDA investment property in an entity, and you might be able to claim that GST component back, which were part of the build costs. And if you bought it as a individual mum and dad investor, the answer is probably no, you can't claim them back. Is that true or false? And what is the right information?
Well, from our understanding and what's been put out by the ATO, specifically in a private ruling that they made available to the public in April 2021, the answer to your question would be you're correct, Minh, in the assumption that if you're just a sort of mum and dad investor, you haven't got a corporate vehicle set up, anything fancy like that, and most importantly, you're not registered as an SDA provider yourself as the investor, then the indication from the ATO and a determination by the NDIA is that you can't claim back the GST you've paid in the build. In order to do that, you would have to be yourself as the investor, a registered SDA provider, and you would have to satisfy a number of other conditions that the ATO goes on to list that I'm not going to get into the specifics of, but number one, you'd have to be a registered SDA provider yourself. Your business would have to be registered for GST, and you'd have to ensure that the NDIS participant has an NDIS plan in effect and that any supply to that participant is reasonable and necessary. So that's sort of the general guide from the ATO as what's required. So this has come about because the ATO, in issuing that in publishing that decision in April 2021, there was essentially two questions asked of the ATO by, we don't know because it's obviously been privatised. But
Can I ask those questions?
Yeah.
So question one is, will the supply by entity A of the property to the specialist disability accommodation provider under the head lease be a taxable supply pursuant to Section 9-5 of the new tax system, Goods and Services Tax Act 1999, and subject to GST? That's the first question. The second question is, will the acquisition of the goods and services by entity A from the building company for the building of the property be a creditable acquisition for which entity A is entitled to claim an input tax credit? Now, Jess, I have no idea what that means. Can you please explain to our listeners what those two questions means in layman's terms?
Yep, I can give it a go. So question one, that revolves around whether or not whether or not you as an investor, when you're supplying that rental accommodation, is that supply subject to GST?
When you say supply, what does supply mean?
So supply is you've got a rental agreement in place, and because you're supplying the service of having an SDA property available there for the NDIS participant, are you able to claim any GST in the process of renting out that property?
So what's the answer to that question?
So in this specific scenario, the ATO has said, short answer is no, the property will be an input tax supply of residential premises. So this contrasts to what the NDIA have said in their decision that I mentioned earlier, a determination that I mentioned earlier, where the determination by the NDIS minister was that the supply of residential accommodation is GST free. The ATO is saying it's an input tax supply. Now, the difference between those two things is that an input tax supply, so you renting out the property, that's the supply, you cannot include GST in the rent, and you also cannot claim for any GST you've paid in maintaining the property and providing the rental services.
Sure.
This is in slight conflict with, depending on what the scenario was, this is in slight conflict to what the NDIS minister had said in their determination, where they said this exact same supply, so you're renting out the accommodation, that's your supply, isn't a taxable supply. It's in fact a quote-unquote GST-free supply. So the main difference between a GST-free supply and an input tax supply is, like I said before, input tax supply, you can't charge GST in what you send out, so the rent, and you also can't claim for GST in the expenses you incur in providing the property there for rent.
Sure.
A GST-free supply is the same in that you can't charge GST in your rent, but you are able to claim GST for the expenses involved in providing the accommodation, which allows you to rent it out to the NDIS participant. So I think the confusion has occurred because we don't have the full details of this public ATO decision. So we can only assume, based on the facts given to us, which I'll just run through briefly, the ATO was asked in these circumstances where we're talking about the ATO ruling, the entity intended to lease a property to an SDA provider under a head lease in order to obtain NDIS-supported tenants and an OOA for the property to generate rental income. The SDA provider would then be responsible for subleasing the rooms in the property to the selected tenants and also to sublease the OOA room to a registered SIL provider. So that's all we know. There was an investor. We don't know what their circumstances were. They've built a 3-bed HPS plus OOA facility. They are now intending to lease the property to an SDA provider who will then subsequently lease to the NDIS participants and put the SIL in place. So because the ATO, now that's the snapshot. What we don't know is who the entity is or how the entity was set up. Because the ATO in this specific scenario have said, no, entity or investor person who's asking me this question, the supply of residential accommodation will not be subject to GST. We have to assume that that entity or that investor wasn't SDA registered provider and didn't have some kind of company or business vehicle to be registered for GST.
Yep.
So that's really the key considerations that we're understanding here is that you can have two very different outcomes in terms of you being able to claim for GST in your ongoing expenses. So, you're effectively getting GST credits. It completely depends on whether or not you as an investor have the right company structure or business structure that you're set up for GST, and you as an investor or your company that you're using as the investing vehicle is registered as an SDA provider.
Gotcha. Do you think many investors actually are going to their accountant asking for this tax advice on setup? Do you think would accountants understand this?
I would say definitely. I mean, you'd be going to your accountant to get tax advice with regards to your personal situation, which obviously a tax accountant would be well able to explain to you. But
do you think accountants would be recommending their investors to set up an entity, SPV?
I don't think they'd know that.
No.
Yeah, because it's if your accountant did know and say you were a mum and dad investor, you hadn't had anything really set up, and you just came to them and said, okay, can you just make sure I'm completing all my returns properly, recording everything accurately? They might go ahead and record it correctly, but they won't know that, oh, actually, we should have set you up with a business or a company, and we do need to get you registered as an SDA provider, because then you will get more favourable tax treatment.
Sure. I just mentioned the word SPV, meaning special purpose vehicle. Just so our listeners can understand, is that the same thing as setting up an entity or trust to do a transaction, or is it totally different? What does SPV mean, Jessica?
Well, SPV can sort of encompass a lot of things, but it's essentially an isolated corporate entity. There may be a trust, there may not be. I wouldn't even start to think about that, but it's one specific setup, if you will, one specific corporate setup just to deal with this specific investment property.
Gotcha. As a one-off.
Correct.
Yes. Okay. Cool. Moving on. What's our next? My brain's fried now, so I don't know where.
So the other question that was asked of the ATO: will the acquisition of the goods and services by entity A from the building company for the building of the property be a creditable acquisition for which entity A is entitled to claim an input tax credit?
What does this mean?
Basically, can the investor claim back GST on the build costs?
Okay.
In this scenario, short answer was also no from the ATO in this published decision. And they found through a number of different reasons that it wasn't a creditable acquisition, because in this instance, the ATO didn't consider buying or building the property a credible acquisition.
I don't understand what you're saying, because when I asked you 20 minutes ago, I thought that you can claim GST on the build cost if you're using a trust or entity and so forth. You said yes, but now you're saying the ATO in this case scenario here is denying it because they didn't think it was a creditable acquisition. I don't know what that means.
It gets technical, but essentially a credible acquisition is anything you acquire solely or partly for a credible purpose. So you are acquiring, or say in this case, investing in the property for the purpose of carrying out business.
Sure.
So
if you were a provider buying this property to carry on the business, can you or can you not claim the GST back because that's what?
Yeah. So from our research, and again, assuming because it's the same entity here in the ATO scenario, it doesn't appear that the entity is either a registered SDA provider and or wasn't registered for GST purposes through some kind of corporate vehicle.
Gotcha.
So the answer to your question would be, yes, you do have the potential to claim GST on a build, i.e. your build is classified as a credible acquisition, which is the key thing in ensuring that you can claim GST for what you've paid with respect to the building costs. But you have to meet certain criteria, and the understanding is that criteria most certainly involves the investor becoming a registered SDA provider. and setting up some kind of corporate vehicle that is registered for GST.
Cool.
Otherwise, it's just a mum and dad investing to try and make a bit of money. It's not carrying on a business.
Yeah, gotcha. Okay. I asked you yesterday, Jess, about SMSFs, which is an entity, corporate trustee in a bear trust, who may acquire a property. Would they fall in the same boat here to be able to claim the GST back?
If there is somewhere in the SMF setup the ability for it to be, well, for whatever company it's associated with, to be a registered SDA provider, then yes.
Okay.
But that's a whole nother thing in terms of the setup. But as long as within that SMSF, you've got an entity there that can be registered as an SDA provider, then it would be the same thing that you do have the ability to claim the costs of GST on the build.
Okay. So let's pull this back to the basics, Jess. In the new calculator, there's an option for pre and post July 2023.
Yeah.
There's also the drop-down menu of the GST input tax credits claimed and not claimed. Do you want to explain to our listeners, if they have the calculator on their PC or laptop, when to choose that GST input or not input?
So that would be if you're sitting there in front of the calculator, and even if it's just that you haven't really done anything yet, you're just trying to get an idea, whatever figures you're looking at, if you want to make sure are relevant to what you're planning to put in place. So if you are intending on setting up a corporate structure and becoming a registered SDA provider, that's what's going to allow you to potentially claim the credits. So you would include the input tax credits. If you're just a mum and dad investor, you're just looking to make a bit of extra income on the side, there's no business, you're not planning to become a SDA registered provider, you're just planning to get someone in to do that for you, you would more than likely not be able to claim any GST and therefore would have to select not claiming input tax credits.
Sure. So Jess, when you've done the drop-down selection of those two scenarios, there's a little bit of a difference in income outcome for the year. Is that right?
Yeah.
Was it a big difference or a very small difference?
It's quite marginal. We're looking at it on a yearly basis.
10 grand, 5 grand or difference?
Yeah, I guess it also depends on the location and everything. But no, it'd be in the maybe sub 5% range. Okay. It's not hugely significant if you're looking at it just as a snapshot of 1 year.
Okay. So just to summarize this, if you're a mum and dad investor who's buying in their personal name, not a trust or entity, you choose the GST inputs not claim.
Correct.
Not claim. Okay, gotcha. Okay. Why do you think the NDIA released? I mean, it seems like not many purchasers of NDIS SDA properties will be in that category of claiming. Wouldn't be.
That's right. And I think what's happened is that what's been realised by the NDIA in their report that they released in June 2023, their Specialist Disability Accommodation Pricing Review of 2022 to 2023, which I'm sure you've mentioned on previous podcasts, had made a number of recommendations and changes that it's flagged as necessary. But recommendation 14 from that report specifically targets the tax incentives and this exact situation that we're talking about. So the recommendation 14, the part relevant to what we're talking about today, is that the Australian government should consider amending a new tax system, brackets goods and service tax, brackets GST free supplier NDIS scheme supports, Determination 2021. That's a mouthful, but basically what we were talking about at the start, the NDIS made that decision about GST-free supplies. So should the Australian government consider amending that NDIS determination to clarify that the intention of the determination is that input taxes should be creditable for all SDA developments, whether or not the dwelling is developed and or owned by an entity other than the SDA provider responsible for the dwelling's ongoing management. So long story short, I think the NDIA have realised that there is this tricky scenario and you must be in
the grey area.
The grey area for, it's majority mum and dad investing, but they're not being able to best take advantage of being able to claim input tax credits, so GST credits.
I want to read 2 paragraphs here that's in front of me here, Jess. I think it summarizes everything. If you're sitting back on your lounge right now listening to this podcast, you're wondering what the hell is this going on? What the hell is this topic all about? Let me just read 2 paragraphs, and it summarizes everything. And I'll quote word for word. It is important to note that in this case before, we are assuming that the entity was not an SDA provider and or not registered for GST. As discussed earlier, it is possible to claim input tax credits for the acquisition of SDA property where the above-mentioned conditions are met regarding creditable acquisitions. And the second paragraph is, so the question everyone's asking is, what is the process for claiming GST tax credits for SDA property investment? And here's the answer. If an investor is determined to be able to claim GST tax credits for their SDA property investment, they need to ensure that they are registered for GST and appropriately document and keep all records of GST paid on the purchase price or bill price so that they can claim the GST credits when they complete their BAS. And on a side note, everyone, if you look at your contract, your building contract with your builder, there will be a GST figure in the bill price. So in summary, it's recommended to seek your professional advice and refer to all government sources for the most accurate and up-to-date information regarding claiming GST tax credits for SDA. I think we're clear now. Go seek advice.
Yeah. Yeah. Basically, if you want to maximize the benefits, you need to speak to your advisor about how to do that, how to become an SDA provider, and how to set up a structure that's right for you and your investment purposes.
Our experience in the last 3 years, Jess, is very rarely have we been asked from clients about GST or business trust, business entity setup, and all those claimable tax matters. It's very rare to discuss that because we're not accountants ourselves. And maybe you are, but not us. And we always say, go to your accountant and talk about it. So we're just raising this podcast topic today just to say, hey, everyone, there are some tax implications to buying or disposing or acquiring, whatever, your investment in SDA. Go talk to your accountant, your tax advisor. If they don't know, seek advice from someone else. As Jess just said earlier, even they may not understand this, but they should at least understand the concept of setting up a SPV, special purpose vehicle, for a one-off transaction like this. If you're buying one, if you're going to build a portfolio long term, then maybe something else to set up there. And that's it. Jess, any final words of advice from you about today's topic to our mum and dad investors, please?
I guess when you're going and asking for that advice, just remember to ask if it hasn't been brought up to you. Okay, accountant, advisor, thanks for that. Have you considered whether or not I should become a registered SDA provider and become registered for GST in the advice you're giving me?
I think, yes, most of the time people are not going to bother with going down the path of trying to become an SDA provider. They probably won't. It's just too hard. That's the reason why they actually engage an SDA provider on their behalf.
Yes.
Yeah.
So, again, that's a question that you can pose to your accountant because it may not be worth it. The costs of setup and everything and registering, it may not be worth it for what you're trying to do, but it is something that you should have your advisor consider when they're giving you the advice customized for your situation. And it's also important to keep in the back of your mind that a number of these recommendations from the Specialist Disability Accommodation Pricing Review report of June 2023 that we spoke about earlier are expected to be adopted, right, Min?
Yes, correct.
Yep.
I mentioned some words earlier in our session, 30 minutes ago, the word private ruling. Jess, what is a private ruling? When does it occur? Is it easy? Is it costly? Should one do it? I mean, I've always thought when in doubt, you can always ask your accountant to do a private ruling lodgement to the ATO. What is a private ruling, please?
So a private ruling is when your accountant or financial advisor specifically asks or puts your situation to the ATO because they're unable to determine from the information out there how it applies to your specific situation. The ATO, and from my understanding, it can take quite some time to receive a decision, but the ATO will come back to you with their ruling. However, you cannot rely on it as advice. So your accountant would then look at the ruling and go, okay, this does or doesn't make sense, or this does look appropriate for what we're planning to do. And they would use that ruling to make sure that you're not going to get caught up potentially or unintentionally doing the wrong thing with regards to the ATO.
Yeah. Look, I don't think this topic of a private ruling applies to many people at all. If you are a sophisticated investor or developer or provider doing lots of multiple things with different assets and funds going around in the SDA space, NDI space, then maybe you might seek a private ruling for your complex setup. But for the average mum and dad, they wouldn't be doing it, And just private rulings, are they a long drawn-out process, or are they pretty quick? Do you know?
My understanding, it may not necessarily be drawn out, but it's long. Yeah. So you might not have to continuously give information over a long period of time, but it might be quite a period of time between giving the information and actually getting a response.
Gotcha. Okay. Are there any other GST or tax topics that we should also cover before we finish off this session?
That's pretty much it, because we've talked about GST with respect to building the accommodation, and we've talked about GST with respect to the ongoing supply. I think that would be more than enough for everyone to try and digest before we potentially look at what happens on disposal or anything like that. I think this is a great way that you've set up the topic, Min, because it's all about what you consider at the start, things to consider.
I want to add one more tax topic. If a person sells a property after 2 or 3 years old, being an SDA property, and it's tenanted, there's an SDA provider, you, the landlord, is selling it to another investor, is that sold as an ongoing concern or the normal property investment? And how is the capital gains treated to the investor as a CGT when that happens? Is that a topic that you can answer, or can I try and answer it first and you try and confirm if I'm right or wrong?
I'll let you go first.
Okay. Me, going concern, I don't know. I don't know the answer to the question. But if you made $100,000 profit on your sale of your property, so your purchase price, acquisition costs, sale price, disposal costs, so there's a net profit, gross profit margin in there. Those gross profit, when it's realised in that financial year, is going to be added to your taxable income at the marginal tax rate. So there's your tax payable. That's how that is, like all property investment, capital gains tax, right? Any difference there? That's pretty normal. Sold as a going concern. Do you know what that means?
Going as not.
Is a head lease in place?
Yes.
So we do a lot of work with other developers who may sell a project, apartments, or one-line buyers, where it's sold with a head lease in place and it's going concern, and that may have a GST implication there. Do you know that answer to that question or not at all? And it's okay to say no.
Yeah. Not.
If it's sold with a going concern, it removes, I think, I like the word I think, because it doesn't mean that. It means that I think there's no GST applicable. So if you are selling a property to a business or an entity who's buying that SDA property off you, you would charge GST, I think, to it, or not. And then sold as going concern, there's no GST. Yeah, no GST, I think. Do you have any comment here?
Not with regards to property or SDA property. Generally speaking, going concern, my understanding wouldn't attract GST, but that's
correct.
That's from a business to business sales perspective.
Yes, I'm seeing transactions right now on our books where we're seeing plus GST on the $10 million sale.
Yeah. When
our provider or development business buys off another developer. So you got to add the GST onto it as well. Normally, mum and dad buy it. There's no plus GST on top of the sale price, right? But if it's sold with a going concern, there is no GST attributable to the transaction because of the head lease in place and the income coming part of it. That's all. It's just a comment. I thought I'd ask you whether you knew anything about that or not.
Yeah.
But you just confirmed what I just said, which is no GST part of the transaction if it's sold with a going concern, which basically means a head lease on it. Anyway, that's a different topic, not relevant today. Today's all about GST tax input credits. That's all. Lastly, we're not tax advisors. We're just two nerds in an office talking about GST, which we think we're right? We're not saying it's right or wrong.
We think we've figured it out.
Yeah, but not that anyone's asking us for this advice. No. It's just general advice. No, sorry. It's a general discussion by two idiots on a microphone. That we hope that you can use as a listener to go on to your own little journey to your accountant to talk about this topic. That's all it is. Yeah, it's a one-off topic.
Good thought.
Yeah, that's all. Thank you, Jess. Bye-bye.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this podcast with those that could benefit. Until next time, catch you on the next episode.